Good morning, everyone. Welcome to my first episode of Investing Lens. Today, I will be analyzing Google. For analyzing equities, I use a 6-step valuation process, which consists of the steps shown on the slide. So what is Google? Google is a technology company that focuses on artificial intelligence, search engine, online advertising, cloud computing, and many other areas that creates a vast ecosystem. Google's three main segments are Google Search, Google Cloud, and YouTube, which are all highly competitive markets, but they're fast growers, especially Google Cloud. For industry analysis, Google is in three main ones: digital advertising, cloud, and streaming. For the digital advertising market, as seen from this graph from Statista, it is growing rapidly and it is expected to double in 10 years. Competitors for this market are Amazon, Criteo, Meta, Twitter, and of course there are others. Additionally, Google's net ad revenue as a share of worldwide, as a percentage of total digital ad spending, is the highest, and it's at 27.5% compared to its competitors. In fact, if you can see from 2020-2021, which was an extraordinary year for advertising revenues, Alphabet grew at a 42%, which is incredible returns. For the cloud market, there are three main players: Amazon's AWS, Microsoft Azure, and Google Cloud. Google is currently 10% of market share, but as Google keeps growing and the market keeps growing, the opportunity of the cloud market is going to be massive as the world goes digital. Finally, for the streaming market, we have a clash between old and the new, where the digital streaming is disrupting television. In this disruption, YouTube is positioned in a really good spot to gain market share and continue growing. This is also due to demographic shifts where younger people watch news and entertainment on mobile devices, not on the TV. In fact, Fortune Business Insights are expecting a 20% compound annual growth from the increase of adoption of online social media platforms and rising internet connectivity resulted in the high growth of the global market. Google has a lot of competitive advantages, mainly coming from the economies of scale and brand. With time, they manage to hire a strong workforce, which helps them develop and maintain top AI training for advertisements and search engines, which increases switching costs for consumers in the ecosystem. With the current trend of the megatech convergence, it is very important for the ecosystem to remain strong. Google's CEO is Sundar Pichai since October 2nd, 2015. On a CNBC interview, he said that he's focusing on core technological advancements, taking a long-term view while keeping the business diversified. Since he's been assigned as a CEO, there's a clear track record of value creation when comparing it to the S&P 500, outperforming by 160% even with the current downturn in the markets. Now, getting to the interesting parts, Google's financials are in a very healthy position with a very strong balance sheet. Google has a very low debt with a debt to equity ratio of 0.10. And when looking at the historical PE ratio, right now it is at a very interesting level valuation-wise. And if they maintain the high enterprise value growth and they keep compounding earnings, they will continue creating value. Google right now has a financial leverage of 1.43. And when considering their interest expense coverage of 263 times, they are in a safe position. Additionally, they have a very high return on invested capital, high return on equity, and high return on assets, which is good in a possible diminishing margin macroeconomic environment with this. Google, like every company, has risks. In fact, 80% of the revenues come from advertisements. Therefore, reduced spending by advertisers could heavily impact Google's financials. Additionally, as seen from industry analysis, they operate in very competitive industries, therefore they need to constantly innovate, get the best talent, and invest heavily into R&D to maintain their leadership positions. Furthermore, with the European Digital Markets Act, which aims to reform and prevent tech giants from abusing their market positions to harm smaller European rivals. And this could lead to the big tech potentially facing fines of up to 10% of their global revenues, which would heavily impact any big tech like Google. The price target I get from my 5-year DCF model is 4,363. The DCF model will be in the description, but I will talk about it in the next slide. But it should be noted that the stock split coming the July 15th could create some momentum. Now, fundamentally, it does not mean anything, but through options trading, some bullish momentum could happen and we could see some relief in the stock price. So this is my 5-year Google DCF model, and the output that comes from a perpetuity approach and an EBITDA approach is the average is 4,363. And from the current price, it creates an upside of 86% for Google stocks. The inputs to get those values are, I extrapolate the year-over-year growth assumptions of the revenues, and I went conservative and decayed over time with a heavy growth for YouTube and Google Cloud in the future. I did the same for the cost of goods sold, which surprisingly, they're very consistent. So it was easier to extrapolate than the revenue growth. And with these values, I get an EBIT and EBITDA, and using a 21% US corporate tax rate, a discount rate of 12%, long-term growth rate of 4%, I get the perpetuity value. And for the EBITDA multiple, I use a 15x, which is conservative. I could have used a 17x or a 16x. And with semi-conservative assumptions, I get an 86% upside for Google stock. In conclusion, Google has a pristine balance sheet, pristine track record. It's been having stable high growth. It has high upside as seen from the DCF model. Therefore, check if the risk and reward mentioned fit your portfolio criteria. But again, as a disclaimer, this is not financial advice. It is an analysis to give you a new perspective or a new lens for a specific equity. However, personally, Google at this level is a good add for a long-term portfolio. This leads to the end of the video. If you liked the analysis, feel free to like and subscribe. And as of right now, I will upload one in-depth analysis every month, and I will raise it to 2 videos a month from September. So thank you for watching, and I will see you next time.